Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Washington, we have a problem. Now, of course, I'm giving a little nod here to the famous exclamation by astronaut Jack Swigert after an explosion in the Apollo 13 capsule. What he actually said was, "Okay, Houston, we've had a problem here." And when Mission Control asked him to repeat the transmission, Commander Jim Lovell replied, "Houston, we've had a problem." And this ultimately got shortened to, "Houston, we have a problem." And that was kind of made famous in the movie Apollo 13. Now, imagine for just a moment that after hearing this news from the Apollo 13 capsule, Mission Control in Houston just went on with business as usual. That's pretty much what the government people in Washington, D.C. are doing. There's a problem, and they're just pretending there isn't one. And it's a big problem, too. Over $35 trillion worth of trouble. Now, it didn't get a whole lot of media buzz, but we got the final budget deficit numbers for fiscal 2024 a few days ago. Keep in mind, the federal government's fiscal year ends in September, so we're now actually in fiscal 2025. Here's the short version. The Biden administration ran the third largest budget deficit in history in fiscal 2024, and it paid over $1 trillion just on interest payments on the debt. That's the first time that's ever happened. So I'm going to say it again. Washington, we have a problem. And people wonder why so many countries are interested in distancing themselves from the dollar. The fiscal train is heading toward a cliff, and the engineers in D.C. are just shoveling coal into the steam engine and basically pretending that there's no trouble at all. Now, here's the crazy thing about the deficit. This is the kind of borrowing and spending one would expect during an economic crisis. The only bigger annual budget deficits both occurred during the COVID lockdown era. And before that, the Obama administration ran the only $1 trillion plus deficits during the Great Recession. And yet here we are in what is supposed to be a robust economy. It's just booming, it's plugging along. It's great. And yet we still have these crisis-like budget deficits. And, I'm just going to throw this out there, but maybe the robust, awesome economy is really an illusion created by the government deficit spending. After all, it's all supposed to be stimulative, right? So we're stimulating the heck out of this economy. And I'm pretty convinced that's the only thing that's keeping it from completely going under. Now, I know all of this sounds bad on the surface, but let me run through some of the numbers. It's probably even worse than you think. According to the final monthly Treasury statement, the federal government spent $1.83 trillion more than it took in. The budget deficit this year was 8% higher than the 2023 shortfall, which is pretty darn big. The budget gap represents 6.4% of GDP. That was up from 6.2% of GDP in fiscal 2023. Now, Democrats love to blame the deficit on tax cuts for the rich, right? But the rhetoric doesn't match the reality. The federal government doesn't have a revenue problem. Federal tax receipts came in at a record of $4.92 trillion. That was an 11% increase over fiscal 2023. And last year's revenue was only slightly down from the previous record that was set back in 2022. So the real problem is on the spending side of the ledger. The federal government simply spends too much money. Now, remember how the Biden administration promised that the pretend spending cuts would save hundreds of billions of dollars when they did the debt ceiling deal? Remember that? It was the misnamed Fiscal Responsibility Act, right? It was supposed to cut spending. That never happened. The Biden administration blew through $6.75 trillion in fiscal 2024, a 10% increase over 2023 spending. Through the year, the Biden administration spent over $500 billion pretty much every single month. So, really, these numbers tell you everything you need to know about government promises of spending cuts. Government people always find new reasons to spend money, even as they pontificate about fiscal responsibility. Whether it's a domestic crisis or a war, whatever, government spends more and more and more and more and more. So this is why the deficits continue to expand. It's not because of some imagined lack of sufficient revenue. And let me say this, I keep talking about the Biden administration because they're the ones in power right now, but it's not just Democrats spending like drunken sailors. And I say that with all due respect to any drunken sailors that are out there. As I already alluded to, prior to the pandemic, the U.S. government ran budget deficits of over $1 trillion just 4 times. They were all by the Obama administration, and they were all in the aftermath of the 2008 financial crisis. Now, not that it's a good thing, but you generally expect bigger deficits during major economic downturns. That's because tax receipts drop as economic activity slows down, right? There's not as much stuff going on in the economy, not as much stuff to tax. Therefore, revenues coming into the Treasury drop. Meanwhile, governments tend to spend more money during an economic downturn in an effort to stimulate the economy. So since they are getting less revenue and they're spending more, they have to borrow more. During the Great Recession and the COVID era, they borrowed so much more that the Federal Reserve had to step in and monetize the debt. This basically means that they bought U.S. debt treasuries with money created out of thin air and then injected the new money into the economy. They took the debt and they turned it into money. This is, by definition, inflation, and it's a recipe for the kind of price inflation we saw after the pandemic. I'm going to get into this a little bit more here in a bit because it's important. But anyway, you might excuse the big Obama deficits if you are inclined to give a pass due to the recession. I'm not inclined to do that, but let's be honest, this is the typical mainstream position, and it is a justifiable excuse for Obama running those big deficits. Not that he wasn't a big spender before the Great Recession. But enter Donald Trump, right? The Trump administration almost hit the $1 trillion mark in 2019, and it was on pace to run a $1 trillion deficit in fiscal 2020 before the pandemic, even as the United States supposedly enjoyed the best economy ever. So we had a Republican president running massive budget deficits, and he couldn't even use the recession excuse. The economic catastrophe caused by the government's response to COVID-19 gave policymakers an excuse to spend with no questions asked, and we saw record deficits in 2020 and 2021. All of this reveals the ugly truth. Borrowing and spending is a bipartisan sport. And here's the problem. Tackling a budget shortfall is politically painful. It requires spending cuts and or tax increases. Now, Republicans love to talk about spending cuts, right? They'll campaign on cutting wasteful spending, but they aren't really willing to cut deeply because their constituents want government to buy them things like safety and security. Meanwhile, you've got Democrats, and they're always talking about tax increases. They love them some tax increases, but only on the rich. And the fact is, the rich don't have enough money to cover the spending gap and service the massive national debt. The rich can't do it by themselves. You have to tax the middle class in order to shrink that shortfall and address the national debt. So, and this is especially true because once the Democrats start getting more money, like if they raise taxes and revenues start coming in, it's not like they're going to go start paying off the debt. They're going to find new things to spend money on because that's what they do. After all, their constituents want them to buy stuff too, right? Democrats and Republicans might have different spending priorities, but let's be real. Let's get honest. They all want to spend. Now, what is the overarching goal of a politician? No, it's not serving the people. It's not making the world a better place. It's getting reelected. And guess what? You don't get votes by cutting spending and raising taxes. So politicians are always going to keep up the borrowing and spending because that's what the electorate ultimately wants. Now, what the electorate really needs is for some grown-ups to say no, but that ain't happening. Now, there's a pretty substantial group of people out there who will tell you that deficits don't matter, right? It's fine. Nothing to see here. And really, I think that's why you don't see more reporting on these big deficits in the national debt. It's like nothing to see here, right? I think a lot of them just figure nothing bad's happened yet, so, everything's going to be okay. And, honestly, I kind of get this from a casual observer. Like, I'm old enough to remember when the Republicans were squawking about the debt and spending in the 1990s, right? You had the Republican Revolution and Newt Gingrich and all that. And decades later, here we are. None of the things that they warned about have come to pass yet. So, of course, people just assume, well, they never will. They figure it was just political grandstanding. It's really wise to remember nothing happens until it does, right? Now, there's a smaller, but probably even a more vocal group of people who claim that because the U.S. issues the reserve currency, there really isn't any limit to the borrowing and spending, right? They call this modern monetary theory. It's not really modern, and it's a stupid theory, but it's out there. And these people claim that you'll actually hear this, our debt is our savings. And, they can throw out some pretty convincing accounting tautologies to, quote unquote, prove their point. Now, it's all smoke and mirrors. Nevertheless, a lot of people are convinced that they're right. Now, of course, the people who are really into this, they have a vested interest in believing the MMT myth because they especially want the government to buy them things, right? Money printing is the way. Anyway, there's one big problem that even the most sanguine budget observer can't ignore, and that's the interest on the national debt, which is spiraling out of control. Get this, Uncle Sam paid $1.13 trillion in interest expense in fiscal 2024. It was the first time interest expense has ever eclipsed $1 trillion. Interest payments were up 28.6% over fiscal 2023 levels. The U.S. government paid more in interest than it did for national defense. It paid more in interest than it did for Medicare. There was literally only one spending category that was larger than interest on the national debt, and that was Social Security. Social Security, they spent $1.46 trillion over the course of the year. So we're not far from having the interest on the debt cost more than Social Security. Net interest expense, which factors in the interest that's earned by the Treasury and kind of offsets some of that expense, was still $882 billion, and that's still more than national defense. And this interest expense is only going to continue to go up. I've said this before, most of the debt that's currently on the books was financed at very low rates before the Federal Reserve started its hiking cycle. Every month, some of that super low-yielding paper matures and it has to be replaced. And when they replace it, it's bonds that yield much higher rates. It's higher interest rates, right? You're maturing the old lower interest rate debt and you have to replace it because, of course, there's no cash to pay off these bonds. They have to borrow to pay for the borrowing. So it's this vicious cycle of ever-increasing interest rates. And that's part of the reason so many people were desperate for the Federal Reserve to cut interest rates. There is so much debt. It's not just the national debt. There's all kinds of consumer debt, there's all kinds of corporate debt. I mean, the whole world is drowning in debt, so it simply cannot function in even a normal interest rate environment anymore. So that was a big reason that you kept seeing this push for rate cuts. We need rate cuts. We need rate cuts, even though it's pretty clear that inflation isn't completely under control. But here's the thing, even with the recent Federal Reserve rate cut, interest rates are still elevated. In fact, borrowing costs are going up. And I'm going to delve into that here in a minute because that's really key, a key thing to understand to really grasp the fact that indeed, Washington, we do have a problem. Anyway, anybody who says deficits don't matter is deluded. If you hear somebody say this, they should be mercilessly mocked for saying such an absurd thing. Sure, I get it. National debt isn't the same as personal debt. You can't compare it to credit cards, which some people want to do. But still, you can't keep growing it indefinitely. There are issues. As the Bipartisan Policy Center pointed out, the growing national debt and the mounting fiscal irresponsibility undermines the dollar. Quote, confidence in U.S. creditworthiness may be undermined by a rapidly deteriorating fiscal situation and increasing concern with federal debt set to grow substantially in the coming years. See, the Bipartisan Policy Center recognizes the reality here. The spending isn't going to get less, right? We can look at this and say, yeah, this is bad. And you would assume that identifying something is bad, it's going to get fixed. No, it's not going to get fixed, as I've already explained. This, ladies and gentlemen, is one of the forces that is driving de-dollarization, right? The rest of the world is watching the fiscal chaos here in the United States, and they're wondering, why would I want dollars? And it's exactly why so many central banks are buying gold and why the dollar's share of reserves is dropping. People are saying, I don't know about this dollar. And of course, the debt spills over into, or not the debt itself, but the ramifications of the debt spill over into the broader economy. Debt leads to lower economic growth, higher unemployment, and less investment wealth. Speaking of the national debt, here are those numbers. It's currently over $35.7 trillion. I mean, it was just a few months ago, I was talking about the national debt eclipsing $35 trillion for the first time. We're already at 35.7. We're on the fast track to 36. According to the national debt clock, that represents 122.28% of GDP. I mentioned a minute ago that debt tends to retard economic growth. It's true. A debt to GDP ratio over 90% tends to depress economic growth by about 30%. So the fact that we're carrying all this debt is actually slowing down private sector economic growth. Now, in the GDP, it looks good because all of this government spending, it's kind of calculated as economic activity, but it's not good economic activity, right? It is crushing and strangling the private sector. I've heard a number of economists talk about the fact that we've been in a private sector recession for quite a while. The only thing that's really pushing this robust economy along is government spending. And as you can see, the government is spending a lot. So, imagine, I guess, if it wasn't spending all that much, maybe we'd have even had some private sector growth. I don't know. But again, virtually nobody in Washington, D.C. has any kind of plan to address the budget shortfalls or the growing national debt. And we're in the middle of campaign season, so I'm seeing a lot of campaign ads. We've got the presidential race. We got people running for Congress. I don't hear anybody talking about the national debt. I don't hear anybody really talking about spending. Every once in a while, they'll talk about how, we've got to stop the inflation, and they'll blame Obama spending for the inflation. But they don't have a plan, right? There's no real commitment. There's nobody out there that's really making that the primary issue of their campaign. And they're not gonna, because like I said, the electorate doesn't want it. So ultimately, the borrowing and spending issue is nothing more than a political hot potato. And it makes headlines every time Congress runs up against the debt ceiling, and that's about it. The Bipartisan Policy Center warns us, regular brinksmanship over addressing the federal debt limit a symptom of broader fiscal dysfunction and mismanagement, could have a catastrophic impact on the U.S. credit rating, the dollar's role, and U.S. global leadership. So these people are playing with fire. And again, I'm going to emphasize this over and over again. Deficits do matter. The borrowing and spending does matter. And just because they've managed to kick the can down the road this far doesn't mean they can do it forever. But it's almost certain that neither Congress nor the next occupant of the Oval Office is going to do anything substantive to address the fiscal train wreck. They're going to spend more. I say this every 4 years when there's a presidential election. This is my election guarantee. I may have made this on the show before, but this is my guarantee that whether Trump wins or Harris wins, in 4 years, the government will be bigger, it'll be deeper in debt, there'll be more spending, and we'll have less liberty. I can guarantee you that. Now, we could argue that one candidate will be better than the other, but neither one of them are going to fix the fundamental problems. I mean, the fact of the matter is, kick the can down the road is a great political strategy because, as I've already explained, nobody wants spending cuts or tax hikes. The problem is, eventually, kick the can down the road is going to run out of road. I say this all the time. The road is finite, right? Now, think about this for a minute. If you have a friend and he is really an irresponsible spender, right? One of these people that's constantly got Amazon packages showing up on their doorstep, right? And he's already up to his eyeballs in debt. Would you lend him money? Yeah, no, right? In the same way, lack of confidence in the U.S. fiscal situation, the fiscal mismanagement, could also lower demand for U.S. debt. People are going to start saying, maybe we should stop lending these Americans money. What would happen if that comes to pass? Well, it would force interest rates on U.S. treasuries to go even higher in an effort to attract investors. And this would exacerbate the interest problem that is already over $1 trillion. And guess what? This is exactly what seems to be happening. So I'm sure as you remember, about a month ago, the Federal Reserve announced a somewhat surprisingly big 0.5% rate cut, an interest rate cut. So the 50 basis points is what they cut by. And the idea, right, was to lower interest rates, right? Well, not so much. In fact, yields, which are interest rates, on the 10-year and 30-year treasuries have spiked since that Fed rate cut. You heard me right. Bond interest rates are going up despite the rate cut. So what's up with that? Well, it reveals a dirty little secret. The Fed can manipulate short-term interest rates by dictate, but it doesn't have the same kind of control over long-term interest rates. What the Fed does cannot impact, or at least not as significantly, interest rates that are farther out. And this is a big problem for the federal government as it struggles with rapidly increasing borrowing costs. So when the Fed announced its 50 basis point rate cut, the yield on the 10-year treasury was around 3.7%. As of the time I'm recording this, we're just over 4.2%. Meanwhile, the 30-year yield was at 4% on the last day of September, or on the last day of that September Federal Reserve meeting, and it's jumped to 4.5%. Now, it's interesting to note here, a little side note, gold has continued to set new records over the last couple of weeks, despite the surge in bond yields. Historically, rising interest rates, rising bond yields are a headwind for gold. But gold is still setting records. I mean, we're setting records almost every day over the last week or so. Jan Newhouse, who I had the privilege of interviewing last week, he's an analyst and he's doing some work for us here at Money Metals. He did an article that talks about and shows that Western investors have finally jumped on the gold bandwagon. The first part of this gold bull run in the spring was primarily driven by Eastern gold buying, Asia, China, Japan. But now Western investors are starting to hop on the bandwagon. And have you looked at silver lately? Silver is over $35 an ounce. Jesse Colombo thinks that we're in the beginning stages of a much anticipated silver squeeze. So I'm going to link to articles, both of those articles, in the show notes page so you can kind of check that out and see kind of what's going on in the gold market. But anyway, we have Treasury yields that have gone up even with the Federal Reserve trying to push interest rates lower. Why? Well, the conventional wisdom, the thing that you're going to hear on CNBC and MSNBC and Fox Business, is that investors are now expecting the economy to be even stronger than they expected as we move forward. Therefore, the Fed may have to cut rates at a little bit of a slower pace. So, we're kind of undoing the interest rate lowering that we saw in anticipation of the Fed entering into this cutting cycle. And, this is certainly plausible, but given that the economy really isn't all that strong, and again, a lot of that strength has been purchased with government borrowing and spending, it's not private sector, it would behoove us to consider some other factors that might be impacting the bond market. I think there are two other signals that the bond market is or at least could be sending. First, rising rates on the long end of the yield curve could indicate that investors are worried about higher price inflation in the long term. So when inflation expectations rise, if they think there's going to be more inflation over the next 10 years, the next 30 years, then investors demand a higher return on bonds in order to compensate for that depreciating dollar. So that's one thing that we could be seeing. And I think it's perfectly reasonable to expect more inflation as we move forward. Because again, we're already entering into an easing cycle and inflation isn't dead. So we're already seeing an increase in the money supply. I've talked about this on the show. So inflation is still alive and well. So it's perfectly reasonable to say, you know what? I'm probably going to need a little bit more yield if I'm going to hold this bond for 10 or 30 years. Second, rising bond yields could indicate sagging demand for U.S. debt. Remember, bond yields are inversely correlated with bond prices. So when the demand for treasuries softens, bond prices fall and yields rise. And it makes sense because it's trying to entice more buyers into the market, right? So you want a better yield and you want a lower price. And what did I just say a few minutes ago? America's fiscal train wreck could very well put a damper on bond demand. And it certainly looks like that may be the case when we look at the way the bond market is behaving. We're seeing this happen. The bond market is telling us there is not as big of a demand for bonds right now. And, maybe it's because people want to put money in the stock market. There are other reasons. But I don't think you can ever ignore that elephant in the room, and that is de-dollarization and the fact that the world is getting a little bit nervous about America's fiscal irresponsibility, not to mention the fact that we've weaponized the dollar, a topic that I've talked about numerous times on the show. So no matter what is causing it, right, rising bond yields are a big problem for Uncle Sam as he tries to finance the ever-growing federal budget deficits. I know that the powers that be in D.C. were hoping against hope that Fed rate cuts would come sooner rather than later and that it would help push these bond prices down so that they could get a little bit of relief from the interest payments. But that's not what's happening, right? At least not so far. Now, it is quite possible that the Fed won't be able to lower federal borrowing costs with even deeper interest rate cuts. As already mentioned, the central bank can move the short end of the rate curve, but it has a much harder time manipulating long-term interest rates. There are too many other contravening factors. Ultimately, the federal government needs the Fed to step in and put its big fat thumb on the bond market. The only way it can do that is a return to quantitative easing. So in QE operations, the central bank buys treasuries on the open market. This increased and artificial demand for bonds drives bond prices higher and puts downward pressure on yields. So this would be an ideal scenario for the U.S. government. It needs all the help it can get to facilitate its borrow-spend addiction. But the Fed runs these QE operations with money created out of thin air, right? It buys the bonds. It's paying banks and other financial institutions to buy bonds that go on its balance sheet. And then that money ends up in the financial system and ultimately finds its way into the economy. This is, by definition, inflation. So in other words, the Fed is between a rock and a hard place. It needs to get interest rates down for the Treasury. Now, here's the thing. Fed officials claim they don't care about government fiscal issues and they're not paying attention to that. I call BS on that. Absolutely. Jerome Powell is very well aware of the financing problem that the U.S. Treasury has. And that is something that is important because at his core, he's a government person. So I call BS on that. But regardless, if the Federal Reserve steps in, if it starts running QE, certainly, but even trying to lower interest rates using interest rate policy, it runs the risk of reigniting price inflation, which again isn't exactly dead and buried. I talked about this in the show a couple of weeks ago. So I really think this is part of the reason gold keeps rallying. I think smart people recognize the inflation monster is just sleeping. It's not dead. I think they realize the Fed is going to have to ease monetary policy much more than they're advertising. I think some people recognize that a recession is looming, that the Fed has broken things in this debt-riddled bubble economy, and that's going to manifest somewhere down the road. I've talked about the fact before that every time the Fed has cut interest rates by 50%, at least, or 50 basis points, at least in this modern era, the next thing is a big recession. So I think some people know that. So this is why people are buying gold. I think they realize that the Fed is going to have to step in, and it's going to mean more inflation. And this is why you might want to think about getting some gold and silver now as well. Now, I know in some ways you might be looking at the price going up and up and up, and you might be thinking, I don't know if I want to buy now. I'll wait till it comes down. Well, I'm not sure it's going to come down a lot. We may get a correction. You know, we're over 2750 now, which is really surprising to me. I didn't think it was going to break 2700 this quickly, much less 2750. So we are kind of due for a correction that may create a buying opportunity, but I wouldn't count on it. This gold bull market and now the silver bull market have a lot of momentum. So you may want to get in now, right? It's a great time to call and talk to a Money Metals precious metals specialist. You call 800-800-1865, and you can talk to those folks. They can help you figure out how precious metals will fit into your strategy, how they can help preserve your wealth, what products might work for you. These guys are fantastic guys and gals, and it's well worth your time to talk to them. If you don't like talking on the phone, I get it. You can go to moneymetals.com. You can talk to a precious metals specialist right there online. Or you might know what you want to buy, right? You may want silver American Eagles. You can get those online. You can find all kinds of products to fit every investment need and some things that are just cool collectibles that you might be interested in. So do it today. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about the things that I've talked about on the show and more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, go sign up, get on our email list. We're not going to spam you to death. We're not going to send a bunch of emails. We're not going to put you on other lists, but you will get great information in your email box. Now, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll be able to also tune into our Market Wrap podcast that airs every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Thank you, as always, for listening to the show. I know that there are a lot of things you could be listening to. I really appreciate the fact that you spend a little bit of time with me each week. I hope you have a fantastic rest of your week, and I will talk to you again next week.